Okay, today we are working on handout 14 for chapter 16. And we have some practice questions. If you'd like to work on those questions, I'll give you about 4 or 5 minutes and then we'll go through them. Hello.
You're like, what the heck? I'm here. I got you for the last time here.
I've only been in here for 18 minutes, no worries. You guys have the handouts on your desk. We're starting chapter 16 and there's some preliminary questions. We have about 3 minutes left before we go over them. Okay, so let's go ahead and walk through these preliminary questions. It says, which of the following is correct about the effective interest method? And the answer is it must be used to amortize a discount or premium unless some other method yields a similar result. So if your investments are material to your balance sheet, then you have to use the effective interest method. But if it's not material and your investment income or amortization of the premium does not require it, you can use something along the lines of straight line. Number two, investment in debt securities are generally recorded at cost, including brokerage and other fees. Now we'll find out after we go through it and we talk about these kind of rules that if companies want to, they can use fair value. It's just for right now, most of them don't fair value all of their assets. It depends on what their plans are for them. When investment in debt securities are sold between interest payment dates, so between interest payment dates means that you have some revenue that you are going to be recording based on the interest revenue. So accrued interest is credited to interest revenue. When a company has acquired a passive interest in another corporation, the acquiring company should account for the investment. And the answer here is B, using the fair value method. So the equity method is another method that we could use, but it's more than passive control. The effective interest method is not a method for reporting investments. It's just how we amortize them. And then consolidation, generally speaking, that's up over 50% ownership or full control. Which of the following is not generally correct about recording a sale of a debt security before maturity date? Accrued interest will be received by the seller even though it's not an interest payment date. So that is true. You're going to receive that. An entry must be made to amortize a discount to the date of sale. That's also true. The entry to amortize a premium to the date of sale includes a credit to the premium on debt investments. And so this is incorrect. And a gain or loss in sale is reported as an other revenue or expense. Any questions about those preliminary questions? Okay, so we're going to jump into accounting for investments. So I like to put this chart up. I think it's good. It comes from the text. I don't keep track of what illustration it is, but we have a couple different types of securities that we're talking about. We're talking about debt, and keep in mind that this is debt that you've purchased, like a bond, and you are holding it. You are not responsible for the payment of it. This is an asset you're using as an investment. Okay, and then the other one would be equity, and that would be stock or ownership in a company. And it depends on what management intends to do with it, how we are going to value it. And so the first one is if management has no plans to sell, then our valuation approach is amortized cost. And if management has a plan to sell, then we use fair value. Now for securities, if management plans to sell, you use fair value. And if management exercises some control, we're going to use the equity method. And that's kind of a summary of things that we haven't talked about yet, but we're going to talk about how we record these and how we value them. And again, keep in mind, as long as they select it initially, companies have the choice where they can select fair value no matter what type the asset is. But keep in mind when they do that, that it means that there's a lot more work at the end of the period to make sure that they're properly valued to fair value. Okay, we've got accounting for investments in debt securities. And so held to maturity, what does that mean? That means debt securities company has the intent and ability to hold until maturity. Trading securities or trading debt securities bought and held for sale in the near term. And why are they doing that? They believe that those investments will earn them more than just keeping it in a bank account. And of course, accounting loves plugs or other buckets. And so available for sale are debt securities not classified as held to maturity or trading. Okay. Any questions? No? Okay, good. Amortized cost is the acquisition cost plus fees adjusted for the amortization of the discount or premium. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between independent market participants. And we already made a little note up here that debt securities that are planned to be held to maturity are reported at amortized cost. And then there's one other thing that I wanted to put here, and you can kind of cross that held to maturity out. Amortization on bond investments. And it's just that note use effective interest method. Unless another method provides similar results. When we purchase securities, we debit investments. We might have something on there like debt investments or bond investments. And then you would credit cash or other asset given up. And then we've got example 1 here. If you take a minute to look at this one, I'll provide the answer. And this is supposed to be 2021, not 2018. Okay, so we have company acquired $1,200, $1,000, 9% bonds at 97% plus accrued interest. Bonds were dated May 1, 2021, which needs to be corrected, and mature on April 30th, 2027, with interest paid on October 31st and April 31st. The bonds will be added to the available for sale portfolio. The preferred entry to record the purchase on August 21 is. So we have debt investments, and we paid 1,200 times 1,000 times 0.97 because we bought the bonds at 0.97% plus accrued interest. And so that equals 1,164,000. Now we have to calculate the interest revenue. And that equals 1,200 times 1,000. So it's 1,200 bonds times their face value, 1,000 each. And we're going to multiply that by 0.09. Nope, excuse me, 0.09. And then we have to adjust it for the number of months. So the bonds are dated May, June, and July. And they make payments on each April 30th. So from April 30th to August 1st, you have May, June, and July. That's 3 months. And we have to divide that by 12 because the interest is given to us in yearly. So we multiply that out, and we end up with 27,000. And so our entry is a debit to, in this case, they use debt investments of 1,164,000. And we have a credit to interest revenue, $7,000. And then we have a credit to how we paid for it, cash. And that is, I'm sorry, this is supposed to be a debit. I just had it misaligned on my paper. And then that's 1,191,000, which is just the total of the two. And so that answer is B. Any questions? Okay. So I wanted to make a note here. What is the entry to record interest if it's purchased at a discount? So we're going to debit cash or interest receivable. Going to debit debt investments. And this would be for the amortization of the discount. And then a credit to interest revenue. What about if we need to record interest and it's purchased at a premium? You would debit cash or interest receivable. And you would credit debt investments. And this would be an amortization of the premium. And then you would credit interest revenue. Any questions? Okay, so now we'll move on to examples 2 and 3. It says use the following information. Patent company purchased 1.5 million of 10% bonds of Scott Company on January 1, 2021, paying 1.41 million. The bonds mature January 1, 2031. Interest is payable July 1 and January 1. The discount of 89,625 provides an effective yield of 11%. Patent company uses the effective interest method and plans to hold these bonds to maturity. So we don't have this recorded, but this is the, what did I say, discount? Discount. 89,625. And then we have the carrying amount of the bonds, 1.41,375,000. So that's what we paid for the bonds. On July 1, the company expects to receive 1.5 million times 0.1 times 6 divided by 12, or 0.5, because that's the amount of time that has occurred, 6 months. And so the payment is 75,000 that they're going to receive. Now, remember, we said we're going to record interest based on an 11%. And so how do we figure that out? We take the carrying amount, the 1.410375, and we multiply it by 0.11, the effective rate, times 6 divided by 12. And so that equals 77,571. And so now we say, well, how much of the discount is amortized? So we have 75,000 minus 77,571. And that equals 2,571. And this increases the carrying amount of our bond. So we have 1.410375 plus the 2,571. And that equals 1,412,946. And then at year end, so January 1, 22, we're going to make our calculations again. The interest calculation remains the same. That's consistent based on the face value of the bond, 75,000. But now we're taking 1,412,946. Oops. And we're multiplying that by 0.11. And that's going to give us 77,712. And so 75,000 minus 77,712 equals 2,712. And so we add that to our balance. And that equals 1,415,658. Now, as this approaches January 31st, I'm not going to have you go through and do 8 years of this, but the expectation is that this will get to $1.5 million. And you'll notice here that we're just making the adjustment within the account. We don't have a separate premium or discount. Okay, so on July 1, 2021, Patent Company should decrease its debt investments account for the Scott Company bonds by right. And so that's D. Said decrease. It's increase. Sorry. Okay. For the year ended December 31st, 2021, Patent should report interest revenue from the Scott Company bonds of, and so what you have to do is you have to add the 77,571 and the 77,712 together. $155,283, and the answer is B. Any questions there? Okay, and so we're still talking about held to maturity securities. And so at the sale for held to maturity securities, you have to calculate the gain or loss. And the calculation is to take your proceeds less amortized cost. And keep in mind, don't forget to accrue interest. Up to date. And the difference is a gain or loss. Didn't leave you a lot of space for this entry, I'm sorry. So the journal entry would be a debit to cash, right? We're selling it, we're disposing of it, we're getting cash. And then if you had a loss, it would be a debit to loss on sale of debt investments. And then your credit would be interest revenue. And this is the portion of the revenue between interest dates. And then you would credit debt investments to remove it off your books. And then if applicable, you would credit gain on sale of debt investments. So you would use whatever the loss or gain is appropriate there. Any questions so far? Sorry, there's a lot of stuff, I know. So now we've got available for sale securities, and we use fair value, and our interest income a lot of times is, or excuse me, our changes in fair value are a lot of times unrecognized or unrealized. So the gains and losses end up going through other comprehensive income. So let's talk about some of the entries. So at purchase, debit, they use debt investments, so I'm just going to go ahead and use that. Either way is fine. And then credit cash. Entry to record if purchased at a discount. And this is interest, sorry, entry to record interest, like the last one. Debit cash or interest receivable. And then you would debit debt investments. And this would be the amortization of the discount. And then you would credit interest revenue. Entry to record interest if purchased at a premium. And so we have a debit to cash or interest receivable. And then we have a credit to debt investments, amortization of premium, and then credit interest revenue. Give you guys time to finish writing those down. Okay, we good? Anybody else need another minute? Okay. So now we have the entry at period end to record a decrease in fair value. And so you would debit unrealized holding gain or loss. And they usually put like debt security, bless you, to indicate. And then credit fair value adjustment. And so the entry at period end to record an increase in fair value would be a debit to fair value adjustment. And a credit to unrealized holding gain or loss for debt. Okay. Fair value adjustment account is a contra type account, but the balance can be a gain or loss. A debit balance increases the value of the debt instrument. Credit balance decreases value of the debt instrument. And we can see here, in the case of a decrease in the fair value, you'd have the value of your asset and then net your fair value adjustment. So that's sort of a credit would reduce an asset, right? And here it's a debit. It would increase the value of the asset. So we can see that makes sense, hopefully. Now, what happens when multiple securities are purchased? And so you use the basket of securities to determine whether there is an adjustment needed. Therefore, a gain on one security can offset a loss on another similar security. That shouldn't be purchased. These are, reported. And so now what entry for the sale of available for sale debt securities? And so you would debit cash, you would debit loss on sale of debt investments if it was appropriate. You would credit interest revenue. Credit debt investments to remove it from the balance sheet. And then if it was a gain instead of a loss, you would credit gain on sale of debt investments. A little note, do not adjust the fair value adjustment account or unrealized holding gain or loss for debt accounts. Sorry, this account did them separately. A new assessment will be taken at year end and the change reported. Without the debt investment sold. Got to shake out those fingers after all that, right? If there are no questions, we'll move on to examples 4 and 5. And so take about 30 seconds to read the information. Okay, so it says Landis Company purchased $3 million of 8% 5-year bonds from Ritter on January 1, 2021, with interest payable on July and January. The bonds sold for $3,124,000 and an effective interest rate of 7%. Using the effective interest method, Landis Company decreased the available for sale debt securities account from the Ritter bonds on July 1 and December 31st by the amortized premiums of $10,620 and $10,980 respectively. So I'm just going to start again because I like to start with the effective interest method when you're using it before you're answering any of the questions. So we'd say, okay, well, what's my bond discount or premium? So we paid $3,124,740 for $3 million face value bonds. So the discount 124, or excuse me, the premium 124,740. So the carrying amount of the bonds was $3,124,740 on the date of purchase. So it tells us though that the bonds purchased have a 8% rate and they pay twice a year. So on July 1, we take the 3 million face value of the bonds, we multiply that times the interest rate, and then times the time, 6 out of 12 months. And we end up with payment of $120,000 every 6 months. So January 1 would also be $120,000. Now it says the effective interest rate on this is going to be 7%. And so what I would just want to see okay. So this can be done one of two ways. Because the information is given to you here, they tell you that they have the amortization of the discount. And so you have two ways that you can kind of do this, and I'll illustrate them both separately here. So the first one would be take the 3,124,740 and multiply it by 0.07, and then multiply that by 6/12. And that'll give you 109,380 approximately. The other way to do it is that we know the payment's going to be 120,000, and we said that there was amortization of 10,980. So we know the interest expense will be 109,020. So you can do it either way. And then the 120 minus the 109, 380 should give us 10,620. And the 120,000 minus 109, 020. Was 10,980. Okay, and so what happens to the carrying amount? It decreases as we get towards having to pay it off. And so 10,620. And that equals 3,114,120. And here, 3,114,120 minus 10,980. And that equals 3,103,140. Okay, so we've set that up for you. And it says, at December 31st, 2021, the fair value of the Ritter bonds was 3,180,000. What should Landis Company report as other comprehensive income and as a separate component of stockholders' equity? And so the way you look at it now is you say, okay, here's the fair value, 3,180,000. And we have to compare that to the book value. Which in this case is, we had 3,103,140. $3,180,000 minus 3,103,140. And the difference is going to be 76,860. And so if we go back to look at what kind of entry gets recorded, we have this one at an increase in fair value. So we debit the fair value adjustment and we credit unrealized holding gain or loss. And this would be for the 76,880. Okay. At April 1, 2022, Landis Company sold the Ritter bonds for $3,090,000. After accruing interest, the carrying value of the Ritter bonds on April 1, 2022 was $3,097,440. Assume Landis Company has a portfolio of available sales for debt securities. What should Landis report as a gain or loss on the bonds? And so it looks like we have 3 losses there. And so what we want to do is we want to compare the proceeds. And in this case, our proceeds are 3 million. And our book value, $3,097,440. And so the difference as a loss in this case would be 7,440. Any questions on numbers 4 or 5? Okay. Now we're moving on to trading securities. And trading securities are valued at fair value through net income. So we have journal entry at purchase. This would be a debit to debt investments and a credit to cash. To record interest if purchased at a discount. We debit cash or interest receivable. We debit debt investments for the amortization of the discount. And then we credit interest revenue. To record interest if purchased at a premium. Debit cash or interest receivable. Credit debt investments. Amortization of premium. And then credit interest revenue. Okay. Entry at period end to record change in fair value or a decrease. And so we would debit unrealized holding gain or a loss. And this goes to income. Then we would credit fair value adjustment. And then you have the entry at period end to record increase in fair value. So you debit fair value adjustment. And you credit unrealized holding gain or loss. And reminder, that goes to the income statement. And we use the same process as held to maturity for fair value. And so if the company has multiple securities classified as trading, the gains can offset the losses. Not sure why I had that there, but I will take a look at it and let you know in the next class. And we're jumping to example 6. Okay, it says Jeter Corporation and the following debt securities that were purchased during 2021, its first year of operations. It says all market declines are considered temporary. Fair value adjustments at December 31st, 2021 should be established with the corresponding charge against. And so it's a question of income or stockholders' equity. So we have to figure out, is it held for maturity or is it trading securities? So we take a look at them. We have trading securities, 15,000. And then available sale securities, 20,000. Remember, we can offset the gains and losses. So the two numbers that we want here, 15,000. And with trading securities, it goes through for income. So it's either going to be here or here. And then with stockholders' equity, the 20,000 adjustment that we have to make. And so this entry is C. Any questions there? At sale, compare the proceeds to the amortized cost. And so just like we've done before, and so the journal entry would be debit to cash, debit loss on sale of debt investments, credit interest revenue, credit debt investments to move them off the books. And then you would credit the gain on sale of debt investments, whichever one was applicable. And the same note here, do not adjust the fair value adjustment or unrealized holding gain or loss equity account. This is done at year end or period end, excluding securities sold. Okay, we got a practice one for you guys to work on. And then we are out of here. We'll start here on 10/29. And we didn't get far enough to work on the chapter 16 group project, so it won't be assigned to you guys. At due that date, it'll be due on Thursday. Correct, the group project, I should have made an adjustment to the date, and if I didn't, I will, but it's not gonna be due until the 31st. And we'll have time in class to go over it after I explain the rest of the chapter to you. But for now, you guys are working on this one. By the way, that month end should read December 31st, 2021. Sorry about the date issue. Okay, so let's figure out what was the discount. So base value equals 6,000 times 1,000. Which equals 1 million. I'm sorry, 6 million. The carrying value was equal to 5,880,000. And so our discount initially was 120,000. They amortize it on a straight line basis, so we have 120,000. And the bonds mature on March 31 or March 2026, so that's 4 years and 2 months. So we put in here 50 months. And we want to find out is 2,400 a month. And we have to calculate sorry, 8 months of the amortization. January 2021 to September 2021. And so accumulated amortization would equal 19,200. So we take the 5,880. We add the amortization, 19,200. And we end up with 5,899, 200. And so we're going to sell half. Equals 2,949,600. And so it says our selling price $2,964,000. Our book value $2,949,600. And so the difference 14,400 in this case is a gain. Any questions? I held you over a minute, but you guys shorted me a minute in the beginning, so. Was not intentional. Wish me luck on Friday, and you guys have a good day off on Thursday. And I will see you on Tuesday. Oh, nice. It's amazing how we all seem to do things at the same time. Just the nature of the job.